One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. Hi, my name is Alex Mason and I am your host. Thank you for joining me. I'm really excited now because we're going to dig now into the technical stuff. We spent several episodes talking about logistics, about some of the qualitative aspects of getting ready for your internship, that kind of a thing. But now let's get back to the technicals because I know that that is a huge core of the show and I really want to spend a lot more time now digging into that. So we're going to be talking about the balance sheet today. Fundamentally, what is the balance sheet and what are the different components of it that we need to know? Well, the first thing that you should know about a balance sheet is this is one of the key financial statements of a corporation. So a balance sheet tells you what the company owns versus what the company owes. So what they own versus what they owe. And we represent this with assets and then liabilities and equity. So now what we're going to do is I'm going to just sketch out on the whiteboard a bunch of different things relating to the balance sheet so that you understand exactly what it's comprised of and how the basics work together. So let's go ahead and do that now. Okay, so now what we have is we're going to look at the balance sheet, and you'll see an abbreviation for this as BS usually. And on one side, you'll have your assets, and then on the other side, you'll have your liabilities and your equity. Okay, and so what happens is a company will have certain things that they own that's going to be over here on this side, and then they'll have other things that they owe over here on this side. And this relates to what's known as the basic equation of accounting, which is assets equals liabilities plus equity. So I'm going to go ahead and write that here. Assets equals liabilities plus equity. So no matter what's going on here in this sheet, in terms of the balance sheet, the assets always have to equal the liabilities plus the equity of the company. So let's say that we have $100 in cash and the company has no debt. So liabilities are zero, and that means that the equity must be $100. So that 100 equals 0 plus 100, the balance sheet balances. Very simple formula, and this is just assuming it's a company that literally has nothing else but $100 in cash. So if you own that company, you would own the equity of equal to $100. So that's a very simple example of how this fundamental equation of accounting works. So now let's talk about some of the aspects of the asset side of the balance sheet, and then we'll talk about some aspects of the liability side and the equity side that you should know. So the asset side of the balance sheet, it's really split into two different types of assets. There are current assets, and then there are non-current or long-term assets. So current This is comprised of things like cash, for example. So you could have cash. You could have something like accounts receivable or inventory. Now, why are these called current assets? They're called current assets because they can be converted into cash relatively quickly, or we assume that these things will become cash within the next 12 months. So that's what a current asset is. And then in terms of non-current assets or long-term assets, these are different things. The most common thing that you'll see is something called property, plant, and equipment, or PP&E. Now, PP&E, the easiest way that I think about this is if you have something like a factory and a company owns a factory or some kind of machinery or equipment, that's considered property, plant, and equipment. Yeah, you could sell it and convert it into cash, but it's considered a longer-term asset of the business that the company intends to own for a long time. And so that's the basic breakdown of current assets versus long-term assets. And there are many more things here other than just the examples that I mentioned, but that's just to get you going in terms of understanding the terminology. And sorry about this on the whiteboard, my marker's kind of messing up, but I think we should be good here on the liability side. So let's go ahead and look at liabilities. What are different kinds of liabilities? Well, just like the asset side of the balance sheet, on the liability side, we have near-term or current liabilities, and then we have long-term liabilities. So an example of a current liability would be something like accounts payable. So accounts payable, if a company owes money to another company, but they haven't paid them yet, that's considered a liability because the company owes someone something. But it's a short-term liability because that payment is going to be made relatively soon. It's not something that's going to be owed for a long period of time. So that's one example of a current liability. An example of a long-term liability, the biggest example in my opinion, is debt, long-term debt. So if a company owes a bank money, for example, they borrow on a term loan, they're going to record that on their balance sheet as a liability. So debt. And then another big category here is leases. So leases, if a company, say they lease out a storefront to run their operations, technically that's not debt, but it is an obligation of future cash flow because they signed up to pay that rent every single month. So that can be considered a long-term liability as well. So you could have leases. Okay, so now let's talk about equity. Now in terms of equity, this is what is owned by the stockholders of the company. So another way we can say this is shareholders' equity. And shareholders' equity is comprised of a lot of different things, actually. We're not going to get into those nitty-gritty details today. We'll talk about it more in another episode. But fundamentally, stockholders' equity, that's what the company owes the shareholders of the company. Because remember, the company itself is a separate entity, and then let's say you or I, as investors, buy a piece of the company. Well, we own equity in the company. It's kind of like the net worth of the company, is how I think about it. So this is like the net worth of the company. Just like if you and I own a house and we have a mortgage on it for $200,000, but the value of the property is $300,000, the asset that is the value of the home is $300,000. The size of the mortgage is $200,000. That's a liability, and so the equity in the home is the difference. It's 300 minus 200, which is 100. So that's the equity. And remember, it always comes back to this fundamental equation of assets equals liabilities plus equity. And if you remember that one equation, that's going to help you a lot as we amp up the complexity of these kinds of accounting questions. Okay. So those are some of the basics of the balance sheet. Next time, we're going to be talking about the basics of another really important financial statement called the income statement. So that's what we got for you today. I'll see you next time here on Investment Banking Insights. Bye.